Hello, everyone. As Felicia said, this is, well, it's certainly our first time doing a hybrid. I think it's maybe you guys' first time doing a hybrid too. So forgive us for kind of looking down, looking up, looking all around. Thanks, Felicia, for having us. Christina, thanks for having us. So this is our presentation today. We're hoping to give you guys some personal finance tips that you can, the idea is that these strategies are kind of implementable regardless of your wealth level. You could be a millionaire, you could be just out of college, whatever it might be. These are kind of strategies that can kind of be used no matter what. So, okay, so this is us, as Felicia just said. I am Becca Feeley. This is actually my mother, Keeley. So you know about being a little team, mother-daughter team. I'm from Darien. I went to Darien High School. I graduated in 2006, which now feels like a really long time ago.
She doesn't know all.
Well, you don't want to hear what time when she graduated from Darien High School. I spent a stint in upstate New York for college, and then actually for a few years after college, I met my now husband at Darien High, and we got married 7 years ago, and we now have 3 kids, and we live back in Darien. So here we are, and round we go. And I've been lucky to work with my mom for the past 7 years of my career, and just loving it. So that's me.
And me, I'm Keeley Kriskey. I'm also a Darien native, so I went to Darien High School as well and graduated back in 1980, so a couple of years ago now. After I went to college, I came back and met my husband soon thereafter, and we've been married, it's 37 years now, and it'll be 38 this September. And we raised our 2 children here in Darien. So when I started my career, I actually began it in mortgage banking as well as retail banking. And I worked for Chase, what was then Chase Manhattan Bank, which became JP Morgan Chase. And for them, I would do a number of special projects. So one of which was way back when electronic banking was first starting, I had to create a new group for them, a division that was called workplace banking. And it was trying to figure out how to get people to do direct deposit payroll, which sounds so, of course, now, but back then it was very scary to people. And it was also when things like Quicken and Microsoft Money were first coming out. And so again, it was kind of this mystery, how do you pay bills online? So back in 1996, I was still working for Chase at the time, and a client came in and he had just sold his business, 50% of his business, and he had all these Quicken questions and wanted to know how to keep track of things. And he, by the end of our conversation, he literally said, if I need this service, so do other people. So he became my first client. I left the bank and never looked back. So I started it in 1996. We are considered a daily money management firm, which simply means that we handle people's day-to-day finances. And so we do everything from bill pay to tracking income and expenses, transferring of money, looking at their cash flow to make sure they're not going to run out. And if they are, figuring out strategies to get it back in and do financial reporting for them. So we work as a team with their other professionals. So that's Financial Sense.
Our daughter over here.
And I should say, I didn't mention, Becca joined me 7 years ago now, and during that time, we've gone from a staff of 3, we've now have 6, and we've doubled our client base during that time. So it's been very nice having her on board. I need another Becca.
Felicia, just a little tidbit. The Kristen who's on this call is Kristen McGarry. She works for us part-time, so I know you know her because your kids, I think, were at high school together.
Oh, boy, small world.
Yeah, it is a small world.
So we're here today to actually talk about 5 different, I know we said tips, but it's actually 5 topics, and you should walk away with many more tips than 5. We're going to talk about credit scores and credit building, and they are very closely related, so you'll see that as we go through the presentation. We're also going to talk about kids and finance, saving strategies, and then how to keep track of everything, stay on top of everything. All right, just before when we talk about credit scores and credit building and whatnot, there's just a little information that I think it's important that you know ahead of time. Right here, you can see that we have 3 credit bureaus. So a credit bureau, when you open a loan or credit card or other loan type activity like that, they keep track. They are the bureau where people report this. So if you have a car loan with Chase, Chase will report your payment history to one or even all 3 of these agencies, these bureaus. And so, you know, they're constantly keeping track every month. Did you pay on time? Did you pay late? How many times were you paying late? This is all important when they calculate your score. And when you pull your score from each of these credit agencies, bureaus, it actually can be different because maybe Chase only reported to 2 of the 3. So there's usually some range between the 3 agencies as to what your score is. Now, scores typically run from 300 to 850, the low being bad. You don't want 300. You want to be as close to 850 as you can get. Why is it important? Your rates, let's say you go for a mortgage, your interest rate that you get offered will be better the better your credit is, and worse the worse your credit is. So you hear these car loan companies saying, oh, regardless of your credit score, well, they're going to give you the worst rate if you have nasty credit, bad credit. So it's really important to build your credit score, make sure it's high, and it'll behoove you later.
And just to tack on, not only in preferential interest rates, but you may not even be approved for a loan if your credit is really bad.
Absolutely.
So that kind of naturally flows into credit building. Now that you know sort of like the baseline of who the credit agencies are and what those numbers mean, how do you ensure that you have a good credit score? And so there's sort of 5 factors that all play into the calculation of your credit score. Some of them are weighted a little more heavily than others. And as this pie chart shows, you can see that your payment history is the single most important thing when the agencies are calculating that credit score. So it's extremely, extremely important that you pay your bills on time, especially the loans or the lenders that are reporting to those agencies. For instance, if you were to pay an Aquarion bill late, that may not, at least initially, be reported to the credit agencies. It's really important that you pay your car loans on time, that you make your mortgage payments on time, that you make your credit card payments on time. And minimums are okay on the credit cards. If you don't have the cash to pay your minimums in full or to pay your balances in full, which is obviously always recommended if you can, so that you're not incurring interest. But as long as the payment is made by the due date, there will be no reporting to the agencies. So that's the single most important thing when it comes to your credit score. Second most important at 30% is credit utilization. So it's recommended for a high credit score to be using less than 30% of your overall credit that's available to you. So for instance, if you know that you're spending $3,000 a month on your credit card, you would like your credit card limit to be at least $9,000 or $10,000 in that range. and you don't want to be using more than that 30% of the overall credit available to you. So, rather than, you know, if you're in a situation where you're spending $5,000 a month and your credit limit is $5,000 a month, that's going to hurt your credit. So we would recommend the best way to get under that 30%, rather than applying for another credit card, would be to just simply contact Chase or
Your credit
Capital
card
One or, you know,
company.
Amex or whoever you're using, and just request a higher limit. And it's unbelievable, really, how often that works. They'll just say, okay. You know, especially if your payment history is there. You know, if you have a history of making your payments, especially in full, month after month after month, they really should have no problem in just increasing that limit for you. So that's a pretty easy way to just make sure that you're underneath that 30%. Next most important factor at 15% is the length of your credit history. So when we get into kids and finances, Mom will actually talk about how to begin getting credit or building credit as early as humanly possible. But the card that you open first, especially you youngins here, don't ever get rid of that card. Keep that in your wallet, even if you don't use it. Say it maybe doesn't have the best cash back, or it doesn't have the best travel rewards or whatever. Don't just cancel the card because you don't use it anymore. It's okay to just keep it in your wallet. Maybe use it once in a while so that they don't just close it on you, so that it keeps it active. But it's important because that card is the longest credit that you've held, and it will continue to be as long as you keep that account active.
What's a good age to open up a credit card?
Well, we're going to get into that,
Yeah,
but no, that's fine.
I was 17.
Yeah, usually they'll open credit for kids like entering into college, so that's where we're going to go.
Yeah. 10% of the calculation of your credit score is based on the new credit opened. The more new credit, the more hard inquiries on your credit in the last 18-month period, the more that it hurts your credit score. So, you know, you show up at Nordstrom or, you know, Kohl's or whatever it might be, and they say, oh, you want to save 15% if you open a Kohl's card or whatever it might be. You don't want to do that. The answer is no.
Because it'll ding your credit. They're going to pull your credit, and which will temporarily knock your score down.
Right. And then the final factor is the type of credit that you have. And they say that like a mixture of different types of credit is a good thing for your credit score. There's two different types of credit: installment versus revolving. Installment would be like a car loan, where it's like you have a set amount that is eventually due. You know, you take out a $10,000 loan for a car, and every single month you owe $350 towards that. That's an installment loan. The loan gets smaller and smaller until it eventually goes away. A revolving credit line is something like either a credit card, where there's no
Pay it back.
Yeah, you pay it back
up.
and then you run it back up, or like a home equity line of credit, where it's just kind of a revolving credit line that you can tap into as you need and pay down as you can. They say that installment loans help to increase your credit, so a car loan is actually a good thing. In fact, you had an experience in the last 5 years or so where you she paid off her car loan and her credit score dipped. Yes. Which is
very
kind of, yeah. You know, you're like, woohoo, and then, you know. So a good mix of types of credit is a good thing. This is just an example actually of one of our clients where we focused on those two, just going back a second, those two main categories: payment history and amount you owe, meaning low credit utilization. So that makes up 65% of the calculation of your credit score. So we focused on, you know, just getting his payments on time. He's got plenty of money. He just wasn't managing it properly. And so we just, you know, got a 4-month period of time where we were just making all of his credit card and loan payments on time every month. and paying down his balances on his credit cards. And in a 4-month period, his credit went up by 83 points. And I believe if we went back to the 743, puts him in the good category and approaching the excellent category. So it kind of just goes to show that you don't need an extremely long period of time to build your credit up. You just need to focus on those big factors that really make a big difference and an impact on your credit score. So now that you know what a credit score is and how to build your credit score, you want to make sure you preserve that good credit score, hopefully excellent credit score. So you want to monitor your credit. A lot of credit card companies now, I know Capital One as well as CitiCard offer just when you log in to look at your credit card balance and activity, you can look at your credit score on a daily basis. So that's a good way. There's a couple of third parties like Credit Karma, Credit Sesame. I use Credit Karma myself. We use it for a couple of our clients. We've kind of gotten into the process of actually setting up an account with one of these companies as soon as a client comes on board, so we can kind of just see a little bit of a pat on the back, but kind of see where they started and now where they are. So, so that's credit scores. And then once a year, you're entitled to a free credit report you can go to annualcreditreport.com, and you're actually entitled to a free credit report, full report, not just your score, but all of those things that help play into that score. So you can really kind of see, you can make sure that all the information is accurate. If they are saying that you made a payment late and you know you didn't, then you have a fight to fight, you know? Or if they're saying that there's accounts open that are not open, they're closed, then again, you have a fight to fight. So, so it's good to just keep an eye on it.
I could just add, you'd be surprised at how many people say, well, I cut up that card, and they think that means they closed it, versus it's still there. It's actually active and it's still being reported. And you'd be surprised when people pull their free credit report, they can see, oh, well, I still have Nordstrom, or I still have whatever, especially store cards when they aren't using them. So it's good to get them actually contact the company and close them properly if you have no intention of using them anymore.
And then another way to preserve your credit score is by just freezing your credit. You can go to each of the 3 different agencies and freeze your credit. And really, you can do it with ease these days. There was so much in the news in the last couple of years with hacking and cybersecurity and identity theft. If you're not planning on applying for a loan in the near future, then there's really no reason not to just freeze it, because then if somebody were to fill out an application for a credit card using your name, the application would never even go through, because the lender wouldn't even be able to pull your credit report and therefore approve you for the loan. So it just protects you from identity theft and from inaccurate credit history being reported. So, kids and finances.
This is something that's near and dear to me. When my kids, Becca and Ben, were young, it was something I put into place because they always wanted the really expensive pair of shoes. And I was saying, oh, go to Costco and we can get shoes. And they're like, no, I want the really nice shoes. So we were always doing battle over, what I was willing to pay. So I finally, one of my strategies was I literally said, all right, here's a preloaded debit card. So this was probably when they first started offering these. And the one we happened to use was Visa Bucks. And I literally said, okay, here is what our clothing budget is. A quarter of it for you, a quarter for you, and I would just preload every month that dollar amount. And now times have passed, but back then it was $40 a month that I would put onto these cards for them. And it sounds odd, but it allowed them the freedom to pick what they wanted, and they knew if they wanted the $80 pair, and in today's, it would be, you know, the $150 pair of sneakers. But they knew they would learn, like, if I hold off, I don't spend anything for a month or two, then I'll have the money for that. And ouch, that really hurts when it takes up 3 months of my savings to buy that one item. So it's a wonderful budgeting tool. They learn what is a dollar, like how far will that dollar go? And there are many of these out there now. I mean, back in the day, when Becca was growing up, there was pretty much Visa Bucks and maybe one other. Yesterday, I was just Googling, because I know one of my clients uses Greenlight for his family. But they were like the 20 best, you know, prepaid debit cards for your kids. So these are not set up or attached per se to a checking account. So you don't have to worry about checking accounts for your kids. You literally set up this prepaid, like a credit card. It's accepted where Visa or MasterCard is, just like any other card. The nice thing about today's debit cards is there are a lot of parental controls. So if, let's say, you were saying this, okay, kid, this is for your clothing, you're going to learn how to use clothing, or, you know, budget your own clothing expenses, you could literally restrict where they could use that card. So it can't be used at the gas station or here. You can do restrictions. I mean, it's a wonderful tool because, I mean, think about it. It's the first time they get practice at financial management, like how to live within a budget. And we found, I mean, my kids moved out after college and never looked back. So, and my son can make a dime go like nobody else.
Yeah,
so
he can.
It's a great tool for learning financial responsibility. The other great thing for like kids and teens is teaching them a good sense of savings. Actually, Angie is on this call, and
Angie works for us. She's on the Zoom.
Yeah, so she's on
Mom
this call.
used to babysit her.
Yeah, I know, talking about a small world. But it was her father who actually got me into Quicken, and also he was the one that would talk about these saving strategies. And what they did is they set up where if you deposited money into your savings account, it wasn't like a revolving door. You couldn't put it in and then swoop it out. If you put in $1, he would put in $1. And it was long-term savings was the idea. But again, the power of doubling. So it's the same idea. And today, some of the people here are younger, so when you get offered a 401k through your employer and they're willing to match it, is so important to max out on that, because it's free money that somebody's sending you. So just again, as you can catch a kid when they're small and they have allowance, and if they're willing to take a percentage, maybe they get $10, they put $5 into a savings, and then you match it, oh my goodness, they're gonna see instant improvement, and it'll just, again, it's building a pattern, a habit. So that's good. With young adults, when I think of, one of the things I share with my girlfriends,
kind of to your point about when to open a credit card,
is when they go off to college, there's 2 ways to handle this. The bad way would be the way my brother did it, where he opened a credit card and the bill went to him, and of course he would run up the card dating some gal that he met there, and come due date, he had no money to pay it back, right? He's been using his card way too much. He walks out of college and his credit is terrible. I mean, he's done himself such a disservice.
not only credit score is terrible, but he walks out of college with like
Debt.
a ton of debt.
Interest rates, again, if you have cards, you'll know a low interest rate would be 9.99 versus, it can be 29.99%. So you're paying a lot of interest on balances. So the bottom line is, when your kid goes off to college, I highly recommend that you get them a credit card, and it'd be in their name their social security number. So they're the owner of that credit, but you have the bills sent to you. So as a parent, you are going to pay for their paper and their water and their groceries or whatever you've established that it's okay to put on that credit card. So they're using it for an emergency. You know, they need to get an airline ticket to get back home. If by using that card, but you still paying it, by the time they walk out of college, they have 4 years of credit history. So it's just, they can start their life if they want to get a loan or a lease. Often they want to head for, in this area, everybody wants to head to New York City. And so when they pull your credit to sign a lease, you already have 4 years of credit. And not only that,
and then
but
your mom doesn't have to co-sign or be your guarantor.
there's hidden benefit. Becca, when she got out of college, one of the first things she wanted to look at is getting a car. And I will tell you that a lot of, I thought we were so ahead of the game because now she had 4 years and I knew it was like perfect credit because I had been paying, but still all this time. What I found out is that she wanted at least two forms of credit. So it had to be that and some other. So a credit card and maybe a store card or 2 credit cards, but I would start, and they, typically you hear 18 is when you can get a true credit card. It's actually usually a rising freshman for college is allowed to get it. So my kids actually got theirs when they were 17. And I would recommend that you get one that's worth having. I mean, when we got it, it was like whatever one had an offer, credit card offer. Try to get one that you want to keep forever because, as Becca mentioned earlier,
that's my longest credit history. I still have that Capital One card in my wallet to this day.
Even though
I don't use it very frequently, but
it doesn't have rewards. It's very bare minimum, but try to get something better.
Visa or MasterCard rather than Amex, since Amex is not taken everywhere.
Personally, I would go the MasterCard Visa, but it's a preference, and maybe Amex is the second choice. And I'm not saying open a lot. I mean, I even get nervous saying open a second for them, but if you have the time in, again, that's going to help them later. Even if they don't use that second one or use it once every 6 months, it still has enough, even using it that infrequently, once a year, it keeps it active. So it's considered part of their credit history. That's kids. All right.
saving strategies, are we?
Getting low, we'll keep going. Sorry, I got way off on kids.
20 minutes.
My fave. All right, so automated savings. These are, again, people so often, they'll get a, they want to save, and they, want to put so much away in the IRA this year, and maybe they want to put $5,000, and of course, come the end of year or just before taxes, it's like, okay, your accountant tells you, do you want to put some in? But it's hard to come up with $5,000 or $6,000 or whatever your max is all at once. So what my suggestion, my tip to you is break it up. Set up automatic savings for yourselves. Like if you get a paycheck, you have direct deposit of your payroll. Often an employer will allow you to designate, okay, it's going to go to this account, but they also often say you can put it you can split it. Like you want X percent or a flat amount to this account and so much to a different account. I highly recommend setting up like a savings account where if you don't see it in your paycheck and it's not in your checking account, you're so much more likely to save. The same thing would go for, let's say they didn't offer that and your paycheck goes into your checking account. The longer it stays there, the more you think it's available. Set up an auto transfer. It doesn't have to be a lot. It could be some teeny tiny amount and set it up for weekly. Or is it better to set it up, your paycheck comes in on every other Friday you might want to set up an auto transfer from your checking account or wherever it comes into to your savings account to line up for that paycheck date. Again, it's still available to you, but this way you'd be much less likely to touch it. And you could have it going directly into your IRA. You could have it going to pay down if you have a student loan and you want to pay it down faster. You can set it up so every week, every 2 weeks, every paycheck, X amount goes towards either a savings, an investment, or a loan account you have. It just makes it much quicker. It's a great thing. Also, windfalls. People go, whoop-hoo, I got a tax return. I'll start with salary increase. We have clients come to us and say, oh my goodness, every time I get a salary increase, I just spend more. I don't know where it went.
What club should I join? You're like, wait a minute.
And so a lot of times, if you a restricted amount already. So if you get a salary increase, just taking that extra net amount and shoving it aside. Again, set up either an auto transfer or have your employer directly out of payroll, your paycheck, direct deposit payroll, put it into a different account. It won't feel any different. You have been living on a certain amount already. Or maybe you want to say, okay, I want to take a piece of that and stack up my life a little. You still have put some towards savings or a loan or whatever. Bonus. We have a lot of people that get a bonus each year, and some are a huge percentage of their salary. Others aren't. But if, let's say it's just a windfall, you live within your salary, that bonus can be just immediately shifted into, again, paying down debt or increasing your investments. It's less painful. For others who count on that bonus for their lifestyle, I know it may sound weird, but some of the executives get paid a very small salary, and then they might get $1 million, $2 million in February, March. What they'll do is, one of the strategies we help them come up with is setting up, which we'll get to in a few moments, but setting aside money that they're going to need to get them through the year before the next bonus. And then, so you pull off what you need to survive, and then take that extra amount, and again, reduce debt or put it into investments. And then last is inheritance. I mean, what a great time to be able to pay down debt, or I know it sounds like a broken record,
money you weren't
but
expecting.
And it's wonderful, and it's an easy way to, not painful way of saving. And then lastly, personal escrow account. When I mentioned the bonus, if like contributing to an IRA at the end of the year is too hard, and you didn't want to, let's say you weren't sure you were going to need that money, and so you put it into a savings account. That's probably a bad example. Real estate taxes, big nut. Estimated income taxes, another big nut. It's hard to suddenly write a check for thousands and thousands of dollars for this. So what we do
An
is...
example for you younger people is even like a vacation fund, or like, you're gonna need to save up to buy all the Christmas presents or something that you need to for your family. It can work as small as that even. Like,
right.
You want to go on vacation and it's gonna cost $5,000. Yeah.
Becca had a girlfriend, 20 weddings, was it? Whatever, some insane amount that she had. So she literally needed to set aside money to pay for all these different activities. But an escrow account for like a mortgage, your mortgage company would require that you set aside money as part of your monthly mortgage payment that pays, let's say, real estate taxes and insurance. You can set up that same type of thing for yourself. It can just be a simple savings account where you're setting aside a certain amount per paycheck or per week. So again, you break it up so it's not painful. So if I set aside X per week to go into that savings, when I get that $7,000 or $10,000 bill, which some of the younger people are probably like,
what?
boom. It's there. You
We're
know
planning
it's
for it.
gonna be there. You don't have to worry about it coming up. It's gonna be there. That takes care of that.
All right, saving strategies. And then the final sort of topic we wanted to talk about is how to stay on top of it all. And, there are programs and apps out there called personal financial management software or applications. What we use is Quicken. Quicken's been around since '83, and we have been using it since '96, we think it's the most robust program out there. You can, it links to most banks, so it's one consolidated place where you can have it talk to all your credit cards, have it talk to all your bank accounts, and get all of your spending and income information in one place. You can track your income and expenses. You can pay your bills through it even, so you're not logging into Wells Fargo and paying your bills through there. You can transfer money. Categories are customizable. We've got a couple of clients who don't want to see their dining out as dining out. They want to see it as like bars and restaurants, or, you know, that kind of thing. Or if you want to break your, the point is that you can categorize it however specifically you want to, the spending. You can use a budgeting tool, so it helps you stay within budget on a monthly, quarterly, annual basis. It's a really wonderful program, but it requires commitment and ongoing maintenance. There's a bunch of apps out there. The one I'm most familiar with is called Mint. I don't know if any of you have ever heard of it. It's also, well, it's it's an Intuit product. Quicken is no longer owned by Intuit, but it's less customizable, but it does track your spending, and you can kind of have a general sense of where all your money's going. None of these apps or other programs, as far as we're concerned, are as robust as Quicken, but they do require less maintenance and they're just less time consuming. And that's really the reason that people hire us to do the daily money management services for them, because they've either tried Quicken or just kind of tried to manage their household finances on their own, and they just find time after time after time that they're falling behind and bills aren't getting paid on time, and they're not tracking things the way that they know they should be, and then they know they want to have it done. So that's kind of the reason for hiring someone like us. So as just kind of final thoughts, we decided we'd be happy to and would love to encourage you guys to take advantage of this. Just a free sort of 90-minute Quicken setup session. So if you really do want to get on top of all these things and you feel like you can make the commitment to doing so, we really are only familiar with the Windows product. Mac and Windows are so very different, and the programs actually just look very different. So we don't purport to be experts in the Mac version of Quicken. But we can sit here in the conference room, we can grab a desk or something here at Haven and help you to set up your Quicken file if that's something that you're interested in. So any Haven members or anyone who's been on this call.
Thank you so much.
Thanks for having us.
Thank you.
Well, thank you so much.